Welcome to the next chapter in spring. This session is going to be about making every decision count. The theme of our first spring event has been to think big. Thinking big means understanding that big things actually start small. As investors, we know that every financial decision becomes the cornerstone of our journey towards wealth creation. Getting these decisions right could help us go a long way further. So, through the course of this power talk, I will illustrate a few examples and understand how we could learn to make better investment decisions that will help us create a positive, long lasting impact on our financial decisions. So, I'm going to start with a story that we're all familiar with. It was a hot summer day and we had a crow who was feeling very thirsty and decided to look for some water. So it flew around the city for miles and miles and didn't come across a drop of water. And finally, after endless searching, it chanced upon a pot. And at the very bottom of this pot was a little bit of water. So the crow thought it could dip its beak in to get its drink of water. But then it wasn't able to reach the bottom, and then it noticed all these small pebbles lying around and thought out of the box, what if it filled the pot with these pebbles and then maybe the water would rise up and it could have its drink. So diligently you had the crow picking up pebble after pebble, some of them were small, some of them were big, and throwing them into the pot, and slowly over some time the water level started to rise, and finally the crow had its little drink of water and we have a happy ending. But why am I telling you this story of the thirsty crow? What's in it for you? Is there something that as investors we can learn from the thirsty crow? I believe that there are three important lessons here. The first one that we can learn from the crow is about focus. So right from the start until the end of the story, we see that the crow is focused on a singular objective of drinking water. It doesn't deviate, it doesn't give up halfway through, and that's really important. As long as we're focused, we know where we're heading, that's going to help us a lot. The second lesson that we have from the thirsty crow is about perseverance. Now, if we put ourselves in the crow's shoes, we'll understand that it was a hot day, the crow was thirsty and exhausted, and it still had to go around looking for water. Those aren't ideal conditions to be in. Yet, it didn't give up halfway or think that it would abandon this search for water, right? As investors, we might also find ourselves in situations that are far from perfect and that may not even be conducive towards decision making. Yet, we don't have a choice and we must press on and do the best that we can at any given point in time. The third and final and probably the most important lesson that we can take away from the crow is to value the small things. We often tend to value transactions based on the size, and we don't realize that many small things could actually add up to much more than we imagine. So, I'm going to start with a few examples now where we look at different kinds of decisions that we're making. And the first one is something that I think we all consider to be a small decision and don't pay too much attention to. So here's to making even small decisions count. The first, let's set up the situation. Let's imagine that you've decided how much you want to save every month. You have a budget in place that tells you roughly what your expenses are, and then you know that this is how much you're going to save towards equity, this is how much you're going to save towards debt, and you have a smooth sailing monthly savings plan. This goes on for a few months. At the end of 3 to 4 months, you take a look at your bank balance and it turns out to be much more than what you expected. This is great news because it means everything is going on track, you're doing a good job of managing your money. So what would you do with this little bit of extra surplus savings that you have in your bank account? There are several options, of course. So the first could be that you decide to spend this money. because after all, the savings that you've got that are extra in your bank account has only come through managing your expenses. And if you've drafted a budget, maybe you feel like you're entitled to spend this money. The second option would be to put this surplus savings into a short term FD, because you know that your bank account is not giving you a great rate of return. Or you may be feeling that it's not worth the hassle of transferring the money into a short term FD, then breaking it if you need it on an immediate basis, or continuously renewing the FD. So if you don't want to be hassled or bothered by all of this, you might just let it lie idle in your bank account. But I guess the most important thing here is to understand that you don't want to idle money, because when you do that, it either tends to get spent or it tends to not be as productive as it can be. So it's not working hard enough for you. So is there a smarter option or something else that you could do? Now I'm going to quickly compare a short-term debt fund with a fixed deposit. Now let's start with the returns. With a fixed deposit, you pretty much know what you're getting into. It's a fixed and guaranteed return that you're looking at. With a short-term FD, you could get anywhere from half to 1% more than what an FD of similar maturity is offering you. The second aspect to consider is a penalty. Now, we're all familiar with how fixed deposits work, and if you decide to take your money before the deposit matures, you're likely to pay a penalty to the bank for closing this. So, in mutual fund parlance, this is similar to something known as an exit load. So you could select a fund where you don't have to pay an exit load. But with most FDs, there is always a premature withdrawal penalty that is applicable when you break the fixed deposit before the intended maturity date. The third aspect is what we call liquidity. That means how easily can you access this money. FDs are very liquid, you can access them at any point as long as you pay the associated penalty. With debt funds, you just have to wait one business working day before that money hits your bank account. The last aspect that we look at is tax efficiency. Now, in both cases, you're going to be taxed at your income slab rate, but debt funds actually work out to be better in terms of tax efficiency, simply because in an FD, you will be paying tax on the interest that you earn continuously, whereas in a debt fund, you only have to pay tax when you actually redeem any of the profits that you make, and that too only on the portion that you've redeemed, not on the entire amount. So I think we are left with one smart decision that all of us could make today, starting today at least. Now I'm going to move to another example which every conservative investor would be familiar with. So most of us choose fixed deposits because of the quality and the security that they offer. But every investor in the audience knows that for the last few years, FD returns have been falling and there is a deposit gap that needs to be fixed. So how can we actually fix the deposit gap? Previously, the industry was offering a solution in the form of balance funds. Balance funds are today classified as hybrid mutual funds, and they're nothing but a mix of debt and equity. Now, why would an equity mutual fund be paraded around as an alternative to an FD? The reason was very simple. A couple of years ago in the industry, they were offering regular dividends to the tune of 1% every month. So for an FD investor, it looked like a 12% return from a mutual fund as opposed to say a 6 or a 7% return that their bank was offering them. So this seemed like a great deal, but what we need to understand as investors is that mutual fund dividends are really nothing like your bank FD interest payments. Dividends are not guaranteed and it's not sustainable to do a 1% dividend every month. Yet this was often glossed over and a lot of investors didn't understand this concept. Another reason why this was really not a suitable alternative to a fixed deposit was because you have a fixed deposit is a pure debt investment and you are moving into a hybrid fund which is a mix of debt and equity, and these balance funds at that point in time had more than 65% in equity instruments. So in terms of risk profiling, it was not a match for somebody who's a conservative or first time mutual fund investor. So what can we do now to fix the deposit gap? We can start reworking the investment strategy. Now there are two ways to do this. When you decide to park money in an FD, that initial amount is known as the principal, and the interest that you earn is your return that you're getting from the FD. So one thing that we could do is to rework with the principal. So one option would be to actually invest the principal into debt mutual funds that are of high quality and also liquid. We saw in the previous example how debt funds fare better than an FD. The other option would be that if you are still comfortable with fixed deposits and you don't want to move out into the mutual fund space, you could look at marquee corporate fixed deposits as opposed to bank FDs. Now here your rate of return would be higher. The most important thing in this aspect is to recognize that quality is paramount. So one should never step down the quality ladder when making these investment decisions. And if we look at what the industry tells us, it's always high risk, high return. But in this case, you're staying within the same risk band. You're not compromising on quality. You're just making a smarter choice that is giving you a slightly better return. And we should actively look out for opportunities like this to be invested in. The second strategy is to work with the interest component. So assume you put your money into an FD, then the interest earned on that can be channeled into high quality equity mutual funds through an SIP or a systematic investment plan. This would make sense if you are looking at a 3 to 5 year investment horizon, and this way you are making a calibrated move from debt into equity. So it's a gradual and measured shift that's happening as opposed to moving say 65% of your investments directly into equity that you're not familiar with. So risk taking needs to be done in a measured way. It doesn't have to be drastic, and returns can be better if you're careful with how you do things. So quality and risk management are central to this investment strategy. Now I'm going to move on to our next example. Let's say it's your 35th birthday and you start taking a hard look at your life insurance cover, and you meet with an insurance agent, and he comes up with a couple of policies for you to look at, and you decide to go through the finer details with him. So here he says that I have two policies. The first one is a unit linked insurance plan or a ULIP, and you get 25 lakhs of life insurance in this policy, and the premium that you pay every year is going to be to the tune of 2.5 lakhs per year. This policy is going to be valid for 10 years, and he says that a portion of the investment or the premium that you pay to the insurance company is going to go towards providing that 25 lakhs of insurance, and the balance, which is a majority of the investment, is going to go towards investments, right? And he shows you certain funds, and you notice that some of them have done like more than 15% return in the last couple of years. So you feel comforted with your investment options. Then he also says there's another option that you have. It's called term insurance, and you could have a 2 crore policy where the premium could range somewhere between 20,000 to 35,000 per year. And this policy would be valid for the next 25 years until you turn 60 years old. And then he throws in a caveat saying that, but there's just one thing, there are no investment benefits in this policy. So if you survive beyond the age of 60, you get nothing in return. So now you're thinking, what actually is a better investment option between these two? Let's dig a little deeper. First, let's take a look at the ULIP, right? So under the ULIP policy, you have a compulsory large contribution that is happening every year. So your premium of 2.5 lakhs needs to be paid every year, and At the end of 10 years, you actually have to review your insurance cover again, because once the policy validity ends, then you need to relook at your insurance needs. Now, the third point is that although there are certain good investment options available, you're still limited to whatever the policy offers you, right? And before you decide whether this is a good policy or not, your intention was to start looking at your insurance needs. Now, if you had 25 lakhs of insurance, how many months or how many years do you think is going to last your family's expenses? That should give you a rough idea of whether this is a good insurance policy for your family or not. Now, let's switch to the term insurance policy. So here the contribution is much lesser. It's only about 25 to 30,000 per month, which means that you're looking at an outflow of say 2 to 3,000 per month, right? 25 to 30,000 per year, which means you're looking at an outflow of 2 to 3,000 per month, which is far easier to deal with. And you also lock yourself in at an affordable premium. So now this whatever the premium you fix today is going to be valid for the next 25 years, whereas in a ULIP, you're looking at every 10 years your life insurance cost is going to increase, because we all know that the older you get, the more expensive life insurance becomes. And now you also have this flexibility. So if you had that 2.5 lakhs to invest and you spend say 30,000 on your life insurance premium, the remaining 2.2 lakhs is yours to invest in whatever funds you want. So the world is your oyster. You could choose anything that is suitable to your risk profile, that is suitable for your financial goals, and you can pick funds that are going to give you the returns that you expect to earn as well. So here you have flexibility, you have cost efficiency, and more importantly, when we think about 2 crores of insurance, it's a much larger sum which is capable of providing for your family's expenses and even probably in some cases for your financial goals. So in terms of financial security, flexibility, as well as cost effectiveness, the term insurance policy wins. I'm going to move on to our last example. This is something that every parent would relate to. As parents, we're always trying to think about what we can do for our children, how we can provide for them better, and the intent is always to support and nurture the next generation. Now, imagine when you're thinking about this, a friend or somebody close to you tells you about this great apartment complex that's there at the outskirts of the city, and the amenities are fantastic, the people are great, and when you go and you visit, you realize that it's all true. There's nothing hidden here, and this is exactly the kind of place that you would imagine your children to settle down in when they grow up. Now you've saved up some money specifically for your son or daughter, and you're wondering what to do with that money. So should you invest in this property or should you not? Before I give you an answer or a judgment on whether investing in property is right for your children, I would like you to consider a few things, and your answers to these questions would actually determine whether it's a suitable investment option for your family or not. The first aspect is liquidity. Now, liquidity just means how easy is it to convert your asset into cash. We all have heard of stories of people who've been trying to sell their apartment complexes but are unable to do so because they're not getting the prices that they want, right? So that process becomes long drawn. Or we've even heard sadder stories where people have sold their properties because they really needed the money and they couldn't wait for the price to come to the level that they wanted to. Now, why is liquidity important? Whenever somebody else is the beneficiary, liquidity becomes prime, because they may or may not want to use the asset in its current form. So your children may not want an apartment, they might want to invest in their business or go to college. So in those cases, having it in the form of cash would be much easier. The second aspect to consider would be asset management. Now, asset management, there are two sub aspects, if you want to call them. The first is cost. Now, if you own a property, there are certain expenses that you just have to bear. Tax is given, and then you would have maintenance costs that are associated, repairs, or anything else that you would want to do with the property. Those would all be costs that you need to do. And even if you want to make sure that your asset is secure and all of that, you would have associated costs for that. If you're paying someone to manage the house, that would also fall into the cost aspect. The second aspect within asset management is actually ease. Now, we all know how difficult it is to manage a property when we're not close by. You'll have to find a tenant. If there's a problem, somebody would need to resolve it. So all of these things require time and attention, and it's much easier if you're physically present or if you have someone whom you can trust to take care of these responsibilities. Now, it's up to each person to understand whether they have the infrastructure that will be able to handle the demands of owning a property. The third aspect, which is harder to address, is practicality. Now, you need to ask yourself, if you're buying this apartment for your children, what is exactly the purpose? Are they going to be using it as their own house? If they are, we need to understand, would they be comfortable commuting, say, from the outskirts of the city into the city every single day? Are they going to use it as like a weekend getaway? Or are your children even going to be living here, right? Many of us aspire to send our children abroad to study, or they might get jobs in different cities. So then who is going to actually use this house that you're buying? So these questions are what would help you decide whether this is a good investment decision to make for your family. Before I conclude, I would like to share a small checklist with everybody that could help us make every decision count going forward. So the checklist comprises of a series of questions that we could ask ourselves. The first question is to understand whether risk is effectively being managed. When we looked at fixing the deposit gap, we saw that in the balanced fund situation, risk was not being effectively managed, but in the two alternate suggestions that I had shared with you today, there we saw that risk was managed and that whatever risk was being taken was being done in a gradual and calibrated way. Now, the next question that we need to ask ourselves is about quality. So, we also spoke about how we should never go down the quality ladder when we are looking at fixing the deposit gap or any investment decision for that matter. Now, another question that we need to ask is how liquid is the choice? When we're talking about property, we know that property is not liquid. And in this example, it really matters. If you're leaving something behind for somebody else, liquidity matters to them. Then you need to ask yourself this basic question: is my decision in line with my return expectations? So if I'm expecting my money to work hard for me, is it okay for me to leave it lying around in my bank account? Should I be doing something else with it? Which is why we looked at the small pebble. If you have a certain expectation of what your money should be doing with you, doing for you, then you need to accordingly act on those choices. And last but not least, we need to look at tax efficiency, because the minute you look at making smarter, more tax efficient choices, your returns are automatically going to improve. And before I conclude, I would just like to say that if a crow can make such smart decisions, I'm sure that each and every one of us today could do much better. Thank you.